Good morning, ladies and gentlemen. Welcome to the National Bank of Serbia for the presentation of our latest inflation report. The main feature of economic development since the start of the year are the still present disinflationary pressures, moderate recovery of industrial production, relative stability of the exchange rate, and monetary policy relaxation. Like other European countries, Serbia has been facing strong disinflationary pressures for quite some time already. Year-on-year inflation has been moving below the lower bound of the target tolerance band for quite some time, and it is relatively stable. What is also significant is that the undershooting of the target tolerance band is a result primarily of the impact of disinflationary factors with a temporary effect. And these include low prices of primary agricultural commodities and the consequent low-cost push pressure in the production of food, then the fall in global oil prices, and the absence of administered price growth. On the other hand, monetary policy measures implemented by the National Bank of Serbia in the prior period and orderly depreciation which took place in the second half of the last year have moderated these pressures, so that Serbia is one of the few countries which managed to avoid deflation. According to our expectations, inflation will return within the target tolerance band in the second half of the year, and its return will be aided primarily by the petering out of the effects of low prices of agricultural commodities and the growth in administered prices. Monetary policy measures taken by the National Bank of Serbia so far should also ensure inflation's return within the target tolerance band, and inflation should as a result hover around 4% target by the end of the year. As regards economic activities, the National Bank of Serbia expects Serbia's GDP to stagnate this year, and this is different from the February projection when we expected a mild fall in economic activity. Positive contribution to economic activity will come primarily from the fall in global oil prices and the effects of quantitative easing implemented by the ECB, which stepped up the economic recovery of the euro area and of our other key trade partners. In this context, the contribution to GDP growth will come from net exports and from the fall in private consumption. What's important is that this is the year where household consumption decline will end. So in the coming period, we expect private consumption to step up and to provide a contribution to GDP growth. Our projection of GDP growth for the next year has remained unchanged at 1.5%. This growth will be led primarily by net exports and investments as a result of consistent implementation of fiscal consolidation and structural reforms. As I already noted, that inflationary pressures have been present for quite some time, but the National Bank of Serbia has nonetheless been very cautious and has embarked on monetary policy easing in March this year. Caution was warranted by the risks which emanated from the international environment, but also risks at home. The easing of these pressures and consistent implementation of fiscal consolidation measures have enabled the National Bank of Serbia to relax its monetary policy from March and to cut the key policy rate to the lowest level since the inflation targeting regime was adopted, and this is the level of 6.5%. What's very important for us is that the National Bank of Serbia, on its part, is providing a contribution to economic recovery and to economic growth without jeopardizing its primary and legally mandated objectives of price and financial stability. Thank you. I will now give the floor to Mr. Hinic to present the details of the inflation report. Thank you. Ladies and gentlemen, esteemed members of the press and fellow economists, welcome to the presentation of the May inflation report, where we will set out our views of the current and expected economic developments and explain the decisions the National Bank of Serbia has taken since we last met in February. Currently, inflation is undershooting the target. However, after touching its minimum level in January, inflation has been rising steadily since February and is expected to return within the target tolerance band in the second half of the year. The new inflation projection is slightly lower than the one published in the February inflation report, chiefly due to the expectation of weaker growth in administered prices. In contrast to the February projection of a slight decline in economic activity this year, economic activity is now expected to stagnate. The projection for 2015 has been revised up, owing to a somewhat faster recovery of the euro area, our key trade partner, and a smaller than expected decline in final consumption, supported by lower oil prices. GDP growth projection for 2016 has been kept unchanged at 1.5%. Fiscal performance in the first quarter of this year was quite satisfactory. Consolidated fiscal deficit amounted to 2.4% of estimated GDP, and assuming further consistent implementation of fiscal consolidation measures, it is likely to stay below the level envisaged by the fiscal strategy for this year, which is 5.9% of GDP. We expect not only a reduction in internal but also in external imbalances. According to our estimates, the current account deficit will narrow down to 4.2% of GDP this year from 6% of GDP last year, thanks to the recovery of our main foreign trade partners, lower prices of oil, and revitalization of energy and mining sectors. We proceeded with monetary policy relaxation, hence contributing to economic recovery in an environment of reduced fiscal accommodation. Guided by the assessment that there will be no major inflationary pressures in the coming period, and bearing in mind the recently concluded arrangement with the IMF and buoyant liquidity in the international financial market, we decided to cut the key policy rate to its lowest level since the introduction of the inflation targeting regime. In the period under review, the international environment was plagued by uncertainties over several key issues. The effects of the ECB's quantitative easing on the economy, the start of the Fed's policy rate increases, and the outlook for oil prices. In early March, the ECB started buying government securities issued by member states. The initial results of the new monetary policy measures appear to be encouraging. Real interest rates are going down, and the euro is weakening, which together with low oil prices serves as a catalyst to the economy. The expected effects of the ECB's measures and positive movements of economic indicators in the first quarter have led to an upward revision of the euro area's GDP growth. According to the IMF and consensus forecast, the euro area economy is set to grow 1.5% in 2015. The recovery of the euro area has started spreading out to the region of Central and East Europe. The ECB's quantitative easing and low oil prices have opened up the room for regional central banks to ease their monetary policies further. This, along with the necessary structural adjustment, should help the countries of the region improve their competitiveness in the global market and step up economic growth, despite persistent geopolitical tensions. By contrast to the ECB and other central banks, the Fed is preparing to initiate a cycle of interest rate increases. In its March meeting, the Fed suggested it could start increasing the policy rate in summer, but then failed to make any specific announcements in the April meeting about when this was likely, as the readings from the labor market and the economy turned out to be less favorable. Analysts estimate that the Fed's first policy rate increase could take place in the third quarter, while interest rate futures indicate that the Fed will wait until December. After plummeting to their lowest level since early 2009, global oil prices began to rise, remaining, however, significantly below the levels recorded in the past. As the main factors behind low oil prices are more on the supply than on the demand side, these prices are expected to give a positive contribution to global economic growth. As stated in February, a positive impact on the foreign trade balance and global and economic activity of Serbia may be expected if oil prices stay entrenched at low levels over an extended period of time. This is also one of the reasons for the upward revision of our GDP growth projection for this year. Serbia's risk premium, measured by the Emerging Markets Bond Index, currently stands at 267 basis points. Its decline from the beginning of the year is attributable primarily to the agreement with the IMF and implementation of fiscal consolidation, as well as to the affirmation of the country's credit rating. It should be noted, however, that changes in the Emerging Markets Bond Index were also due to the volatility in yields on the 10-year US Treasury note caused by uncertainties over the start of the Fed's interest rate increases. Ample liquidity in the international financial market and low, and in an increasing number of cases, negative yields on government securities of advanced economies have helped rechannel capital flows towards emerging markets, ours included. An important stimulus in this respect came from fiscal adjustment and the conclusion of an arrangement with the IMF. This is evidenced by the high non-residence investment in dinar government securities in February and March, which fed through into stronger demand for the dinar. An additional boost to appreciation pressures on the dinar came from the reduction in energy importers' demand for foreign exchange, relatively low deficit on the balance of goods and services, and comparatively high net purchase of foreign cash from exchange offices in March. To ease excessive short-term volatility of the exchange rate, without seeking to influence the exchange rate trend, the National Bank of Serbia intervened in the interbank foreign exchange market by both selling and buying foreign exchange. After selling 90 million euros in January, the National Bank of Serbia intervened mainly on the purchase side, buying 400 million euros, and much less on the sale side, selling 30 million euros. The recovery in manufacturing and continued rehabilitation of the mining energy complex, driven by the rising external demand, counterbalanced the negative trends in the service sectors in the first quarter. As a result, GDP stayed unchanged relative to the previous quarter. Promisingly, recovery was recorded for a larger number of export-oriented sectors, laying a sound foundation for growth in the coming quarters. As estimated by the Statistical Office, GDP fell by 1.9% in the first quarter relative to the same period last year. Still, manufacturing experienced positive trends, and its physical volume entered a year-on-year rise following 3 consecutive quarters of decline. Owing to faster recovery of the euro area and lower oil prices, the growth in net exports is likely to be somewhat stronger this year, and the fall in household consumption softer than expected earlier. We have therefore revised upward the GDP projection for 2015, expecting economic stagnation instead of a moderate decline. On the expenditure side, a positive contribution is likely from net exports and to a lesser extent from private investment, whereas final household and government consumption will provide a negative contribution. On the production side, the contribution of industrial production is likely to be positive and higher than expected owing to manufacturing. An impetus is also likely to come from the recovery of production in the mining and energy sectors after the damage to their capacities caused by last year's floods. In contrast, dampened final consumption will negatively affect the activity of service sectors, which will probably be the main negative contributor to GDP growth. A negative contribution is also likely from agricultural production, given the high last year's base, when agricultural performance was very good. Uncertainties surrounding the GDP projection concern primarily the speed of economic recovery of the euro area and the pace of fiscal consolidation and structural reforms at home. However, uncertainties also concern this year's agricultural performance. The projection does not include potential positive effects associated with the Smederevo steel plant. Consistent with expectations expressed in the February inflation report, year-on-year inflation continued to move below the lower bound of the target tolerance band in the first quarter. After falling to an 0.1% low in January, inflation began to rise in February towards the target. It touched 1.8% in April. Low inflation rates are a result of the interplay of several factors: muted aggregate demand, low inflation in the international environment, low prices of primary commodities, notably oil, and the absence of the expected administered price adjustment. Under our central projection, year-on-year inflation will return within the target tolerance band of 4 plus minus 1.5% in the second half of the year and stay within the band until the end of the projection horizon. The expected growth in inflation over the coming period will be led by a rise in only a few CPI items: cigarettes, petroleum products, and electricity, which contributed significantly to the undershooting of the inflation target band in the past year, but also by the effects of low last year's base. The risks to the projected inflation path relate to developments in the international environment, including prices of primary commodities, and to the movement of administered prices at home. To a certain degree, the risks are also associated with the outcome of this year's agricultural season. Assessing that no major inflationary pressures are likely in the coming period, the National Bank of Serbia's Executive Board decided to further ease the monetary policy stance. The board also took into account the stabilization of inflation expectations within the target band, increased investor interest in Serbia owing to fiscal consolidation and the arrangement with the IMF, as well as more favorable developments in the international environment. In the March to May period, the key policy rate was cut by a total of 150 basis points to 6.5%, its lowest level since the introduction of the inflation targeting regime. In addition, in its May meeting, the Executive Board narrowed the corridor of interest rates set in reference to the key policy rate from plus minus 2.5% to plus minus 2%. This measure aims to further stabilize interest rates in the interbank money market. Looking ahead, the monetary policy stance will depend primarily on the assessment of the potential impact of developments in the international environment on capital flows and Serbia's risk premium, as well as on the movement in oil and agricultural commodity prices. In addition, further consistent implementation of fiscal consolidation and structural reforms should open up additional room for monetary policy easing. At the same time, we wish to emphasize the importance of the arrangement with the IMF and express our satisfaction that all quantitative program criteria have so far been met. Net foreign exchange reserves of the National Bank of Serbia at end March were much above the floor defined by the program, and year-on-year inflation moved within the bounds of the agreed band. Furthermore, fiscal developments went in line with the program objectives, and most fiscal consolidation measures were implemented according to the plan. We expect this trend to continue in the coming period, with structural policies featuring as exceptionally prominent, notably in regard to the restructuring of state-owned enterprises and improved environment for new investments, which are the key prerequisite for economic and employment growth in the long run. Thank you for your attention.
Mirjana Brajković iz RTS-a.
Mirjana Brajković from RTS. My first question is the following. You say that you expect the government to prop up growth in administered prices, that is to increase administered prices, and one of the key items in your expectations for inflation returning within the target tolerance band is electricity. What is your calculation? When will electricity go up, and to what extent? And the second question, when we say that inflation is below the target, many citizens are happy about it. They think that there will be no price increases, but what is the downside to it, because the central bank did not meet its objective in this sense? Thank you. As for electricity price adjustments, as far as we know, we expect a restructuring plan by the Electrical Power Industry Committee, and they will define the exact degree by which they will increase the electricity prices. What is important for us is to know what are the effects of a possible increase in electricity prices. There are different scenarios presented in the public from 0 up to an X level, but what is the most important for us is that we took into account a midpoint that is 7.5%, and this increase of 7.5% should push up the index of consumer prices by 0.35 basis points, and the electricity price adjustment will speed up inflation's return within the target tolerance band. Of course, inflation will also return within the target without this scenario. As Mr. Hinic said, we expect that inflation will return within the target tolerance band in the second half of this year, and I also said this during my introduction, and our projection is 3.5% in the second half of the year, even without the electricity price adjustment. Why is it important for us to be on the target? In this way, we increase the credibility of monetary policy, and we also impact the movement in prices through inflation expectations. If households, the financial sector, and so on believe in our projections and if they rely on our monetary policy, any shifts in prices wouldn't be so prominent as it would be the case in situations when monetary policy was not effective. We can also see greater credibility of monetary policy in the past period. We have seen a decline in inflation expectations for several months already. They are on the target of 4%. According to Bloomberg and Nina Media, they are at 3.5%. That is below our target, which testifies to the credibility of our monetary policy. Furthermore, the credibility of monetary policy is also reflected in the level of the key policy rate. In the past, with much smaller increases in the key policy rate, we managed to return to bring back inflation within the target than it was the case in the past, because the public trusts the measures that the National Bank of Serbia implements, so there is a greater credibility of our monetary policy in general. From Bloomberg agency, so as for your target band, are you considering any adjustments, any changes in terms of this for plus minus 1.5%? According to our document adopted by the Executive Board, our target was set for the medium-term period until the end of 2016. We revise our medium-term objectives every year, but it should be borne in mind why we set this target. The main reason is the real and nominal convergence towards EU prices, that is the prices in the euro area. The share of administered prices in CPI is around 20%, and in the past period we had the annual growth in administered prices of around 10%. Contribution to inflation through administered price adjustments that should be harmonized with services in the EU was 2 percentage points, meaning that for these 2 percentage points, if we add to this the target in the euro area of 2%, we will reach the level of 4%. It seems to me that Minister Vujović suggested that you may reconsider the target, that you may change the target. That was the reason why I asked you this. I didn't hear this, and I don't know, but in any case, we do this periodically by the end of each year. That is, we analyze what are the long-term and medium-term objectives and what is the most acceptable target for our economy, especially given the levels of prices in our country compared to prices in the euro area expressed in the same currency, of course. There are different statements as to the decline in the purchasing power, that is in consumption. What is the calculation of the central bank, and why do you expect its recovery? That is the dampening effect on its decline when it comes to demand. So one of the reasons why we revised our expectations as to the economic activity this year from 0.5 to 0 was also the fact that it is quite certain that a decline in domestic demand this year will be much smaller than previously expected as a result of fiscal consolidation measures. And so what was the contributor to this? Namely, aggregate demand was higher. That is, we have seen its smaller decline. The reasons for this are also falling oil prices, so this helped a lot in terms of ensuring greater available income for enterprises and for households, that is, for the entire private sector. And this influenced a lot the fact that aggregate demand this year will not decline as we previously expected, and it will compensate for the negative effect of, that is, for the short-term negative effect expected from falling public sector wages and pensions. An additional contribution also came from non-standard ECB measures. You know what I'm talking about, and this also impacted a lot the fact that the sources of financing are cheaper, and this also led to a decline in lending and deposit interest rates, and opened up more room for a smaller decline in aggregate demand. It is very hard to quantify this at this very moment, but let us say that the entire change in economic, that is the revision of economic activity, is mainly the result of this. It's not a result of it completely, but we also have external demand, which is more favorable. But let us say that this GDP revision is mainly due to this. Do you have any more questions? You have also mentioned NPLs in your report. You mentioned a particular figure at the end of November. And as for December and February, the percentage is higher, around 30 basis points. And what will be the movements in NPLs? Because NPLs are a great problem in our country. According to latest data, NPLs equal 22.6%. This is the level of NPLs for March. So you also mentioned February. Yes. So what we're doing at our central bank and what we have undertaken as our responsibility within the arrangement with the IMF are activities relating to the development of the strategy aimed at resolving the NPL issue. I also wish to emphasize that we have involved many institutions, not only our central bank, but also the Ministry of Finance, the Ministry of Economy, and the Ministry of Justice, because we want to comprehensively solve the NPL issue and problems that banks have in their balance sheets because of a high level of NPLs. What is important for us is that the level of NPLs in the household sector is much lower than the level in the corporate sector, and it is relatively stable. There have been no major shifts for a longer period already. But we have to emphasize that the strategy that should be developed by the end of June is something that should point to directions of solving this issue. If you have no more questions, I would like to thank you very much for your attention.